Good evening, Prof. Our presentation topic are telecommunication and company was chosen by us is Maxis Berhad. The group members are me, Lavanya, GA03694, Nur Shazalia, GA03707 and Nur Adlina, GA03702.
Okay, introductions. Business background. Established in 1995, Maxis was one of the first mobile communication provider in Malaysia. The company is constantly revamping its business model and was one of the first operators to introduce 4G services in 2013. Maxis Communications or Maxis Berhad is a communications service provider in Malaysia. Headquartered in Kuala Lumpur, Malaysia, providing a variety of communication products, application and value-added services for consumers, large enterprise and small and medium business owners. Maxis Berhad is leading company which providing telecommunication services in Malaysia and has over 11.4 million service users currently. In 1993, Maxis Berhad has obtained license to run a nationwide GSM 900 mobile network, which is a local fixed network and an international gateway. Maxis Berhad started its mobile business in August 1995 and commenced its fixed line and international gateway operation in early 1996. Nowadays, Maxis is providing a full set of services on various platforms to satisfy the demands of telecommunication for individuals, small enterprise, and large organizations such as mobile fixed line, prepaid line, and internet broadband services. Okay, next, majority shareholder. Maxis Communication is part of another Krishna's business empire. In 1996, the company launched on Malaysia first the three satellites, Measat 1, 2, and 3. The fourth satellite, Measat 1R, now known as Measat 3A, was damaged and recontracted for launch in June 2009. Saudi Telecom Company bought a 25% stake of Maxis.
Okay, I'm going to explain about few ratios compared 2016 and 2017. Day sales in receivable. There is a decrease of days sales in receivable from 2016 and 17. It's a considerable drop from 40.6% to 27.87%. It's because a high DSO number shows that a company is selling its product to customers on credit and taking longer to collect money. A low DSO value means that it takes a company fewer days to collect its accounts receivable. Account receivable turnover. It's increased in a value from 10.46% in 2016 to 11.23% in 2017. It is a high accounts receivable turnover indicated an efficient business operating or tight credit policies or a cash basis for a regular operations, whereas a low or declining accounts receivable turnover indicates a collection problem from its customer. Average receivable turnover in days. It's decreased in value from 34.9 in 2016 to 32.5 in 2017. It's a similar to reasoning of days sales in receivable. For the ratio days sales in inventory, considerable decrease from 0.79 days in 2016 to 0.4 days in 2017. DSI is the average number of the days it takes from a firm to sell of inventory. A smaller number indicates that a company is more efficiently and frequently selling of its inventory, which means rapid turnover leading to the potential of higher profits. On the other hand, a large DSI value indicates that the company may be struggling with obsolete, a high volume inventory and may have invested too much into the same. Inventory turnover. Sharp increase from 284 times in 2016 to 786 times in 2017. This is due a high COGS value. A low turnover implies weak sales and possibly excess inventory, while a high ratio implies either strong sales or insufficient inventory. For the inventory turnover in days, the ratio shows dividend 365 days by the inventory turnover shows how many days on average it takes to sell its inventory. In this case, it has decreased from 1.29 days in 2016 to 0.46 days in 2017, which is showing inventory is sold faster in 2017. For the inventory turnover per year, it's a similar inventory turnover. For operating cycle, the period between acquisition of goods and the final cash realization from sales decreased from 36.19 days in 2016 to 32.96 days in 2017. A shorter cycle is preferred and indicates a more efficient and successful business. A shorter cycle indicators that a company is able to recover its inventory investment quickly and possesses enough cash to meet obligations. If a company's OC is long, it can create cash flow problems. Working capital. Differences in 2016 and 17. It shows decrease in working capital from negative 253,000 in 2016 and negative 1,04,074,000 in 2017. However, in both years, the working capital has resulted in a negative amount. It means that the company does not have enough current assets to meet its current liabilities. The gap has been decreased significantly in 2017 due to having lesser current liabilities. It typically indicates that the company may have incurred a large cash outlay of a substantial increase in its accounts payable as a result of a large purchase of products and services from its vendors. Current ratio. It shows increase from 0.49 in 2016 to 0.63 in 2017. A ratio under 1 indicates that the company's debts due in a year or less are greater than its asset. On the other hand, in inventory, the higher the current ratio, the more capable a company is paying its obligations because it has a large proportion of short-term assets value relative to the value of its short-term liabilities. Acid test ratio. It's increased from 2016 compared to 2017. Companies with the acid test ratio of less than 1 do not have enough liquid assets to pay their current liabilities and should be treated with caution. If the acid test ratio is much lower than the current ratio, it means that a company's current assets are highly dependent on an inventory. This is a cash ratio. It's increased from 0.13 in 2016 to 0.15 in 2017. It shows the cash ratio is less than 1. There are more current liabilities than cash and cash equivalents. It means insufficient cash on hand exceeds to pay off short-term debt. This may not be bad news if the company has conditions that skew its balance sheet, such as later than normal credit terms with its supplier, efficiently managed inventory, and very little credit extended to its customers. If a company's cash ratio is greater than 1, the company has more cash and cash equivalents than current liabilities. In this situation, the company has the ability to cover all short-term debts and still have cash remaining. High cash ratios maybe indicate that the company is inefficient and in the utilization of cash or not maximizing the potential benefit of low-cost loans. Instead of investing in profitable projects, it's letting money stagnate in bank account. Sales to working capital. The value negative due to the negative working capital. It's decreased 3.73 in 2016 to 4.69 in 2017. Due high due to high sales in this year, in the later year. A high turnover ratio shows that management is being very efficient in using a company's short-term assets and liabilities for supporting sales. In a contrast, a low ratio may indicate that business is investing is too many accounts receivable and inventory to support its sales, which could lead to an excessive amount of bad debts or obsolete inventory. Times interest earned. A ratio means that a company is able to meet its interest obligation because earnings are significantly greater than annual interest obligations. However, a high ratio can also mean that a company has a unreasonable low level of leverage or pays down too much debt within earnings that could be used for other investment opportunities to get higher rate of return. A lower times interest earned ratio means fewer earnings are available to make interest payments. Failing to meet this obligation could force a company into bankruptcy. It is used by both lenders and borrowers in determining a company's debt capacity. Debt ratio. A ratio greater than 1 shows that a considerable portion of debt is funded by assets. In other words, the company has more liabilities than assets. A high ratio also indicates that a company may be putting itself at a risk of default on its loans if interest rates were to rise suddenly. A ratio below 1 translates to the fact that a greater portion of a company's assets is funded by equity. The higher the debt ratio, the more leveraged a company is, implying a greater financial risk. A debt ratio greater than 1 tells us that a company has more debt than assets. Meanwhile, a debt ratio less than 100% indicated that a company has more asset than a debt. Debt to equity ratio. Lower value of debt equity ratio are favorable indicator less risk. Higher debt to equity ratio is unfavorable because it means that the business relies more on external lenders, thus it is a higher risk, especially at higher interest rates. A debt to equity ratio of 1 means that half of the assets of a business are financed by debts and half by shareholders' equity. A value higher than 1 means that more assets are financed by the debt that those financed by money of shareholders and vice versa. Debt to the tangible net worth ratio. It shows generally excess of the debt to tangible net worth ratio value over 1. It means that company creditors aren't well protected, and in case of firms insolvency, they will only recover a part of a principal and interest belonging to them. Lower than 1 ratio indicates the situation when creditors can expect receiving all the amount in full. Net profit margin. It's typically expressed as a percentage but can also be represented in the chemical form. The net profit margin illustrates how much of each dollar is revenue collected by a company translates into profit. In other words, Maxis earned 0.23 cents profit in 2016 for every RM1 ringgit revenue. This figure is not increased in 2013. For the total asset turnovers, it's increased from 0.45 in 2016 to 0.49 in 2017. This is due to a higher revenue earned and large assets valuation in 2017. The higher the asset turnover ratio, the better the company is performing, since higher ratios implies that the company is generating more revenue per dollar of assets. Return on asset. Return on assets is an indicator of how profitable a company relative to, to its total assets. ROA gives a manager, investor, or analyst an idea as to how efficient a company's management is at using its assets to generate earnings. The higher of the ROA number, the better, because the company is earning more money on less investment. For the operating income margin, decreased from 0.36 in 2016 to 0.34 in 2017. The operating margin is how much profit a company makes from its core business in relation to its total revenues. It is a good indicator of how well it is being managed and how risky it is. It shows the proportion of revenues that are available to cover non-operating costs like paying interest, which is why investors and lenders pay close attention to it. It's operating asset turnover ratio. It shows indicators how efficiently a company is using its operating assets to generate revenue. A higher ratio is describable as it shows that a company is better at utilizing its operating assets to generate revenues. For return on operating assets, it increasing in return from 0.428 in 2016 to 0.595 in 2017. This is because due to a higher operation assets turnover in 2017. Sales to fixed assets. It shows a high sales to fixed asset ratio, imply that the business is efficiently using its fixed assets to generate revenues, while a low ratio shows that the fixed assets of the company do not help generate revenues efficiently. Return on investment. It shows when ROI calculation yield a positive figure, it means that net returns are in the black. Alternatively, when ROI calculations yield a negative figure, it means that the net returns are the red because total costs exceed the total returns. Finally, to calculate ROI with the highest degree of accuracy, total returns and total cost should be considered. Return on equity. It is decreased in from 0.45 in 2016 to 0.37 in 2017. Return on equity measure how efficiently a firm can use the money from shareholders to generate profit and grow the company. Unlike other return on investment ratios, ROE is a profitability ratio from the investor's points of view, not the company. In other words, this ratio calculates how much money is made based on the investor's investment in the company, not the company's investment in assets or something else. That being said, investors want to see a high return on equity ratio because this indicates that the company is using its investors' fund effectively. High ratios are almost always better than lower ratios, but have to compare to other companies' ratios in the industries. Revenue on common equity. This is decreased compared to 2016 and 2017. This is due to declining net income in 2017. The ROCE ratio can also to be used to evaluate how well the company's management has utilized equity capital to generate values. A high ROCE suggested that the company's management is making good use of equity capital by investing in NPV positive projects. This should create more value of the company shareholder. Next, the return of total asset variation increased from 0.12 in 2016 to 0.135 in 2017. It's showing an improvement in figures. The greater company earning in proportion to its asset. The more efficiently that the company is said to be used its asset, the ROTA expressed at a percentage of the decimal provides insight into how much money is created from each dollar invested into the organization. Gross profit margin. It shows decrease from 0.68 in 2016 to 0.56 in 2017. This is due to a higher cost in 2017, relatively in comparison to 2016. Generally, the higher of the gross profit margin, the better. A high gross profit margin means that the company did well in managing its cost of sales. It also shows that the company has more to recover for operating, financing, and other costs. The gross profit margin may be improved by increasing sales price or decreasing cost of sales. The next ratio comparison between 2018 and 2019 will be presented by my friend.
Firstly, day sale in receivable. The debt is increase of day sale in receivable from 2008 until 2019. A considerable jump from 28.18% to 47.22%. A high DSO number shows that a company is selling its product to customer on credit and taking longer to collect money. A low DSO value means that it takes a company favor day to collect its account receivable. For account receivable turnover, it's decreased from 12.87% in 2008 to 8.81% in 2019. A high account receivable turnover indicates an efficient business operation or tight credit policy or a cash basics for the regular operation, whereas a law of declining account receivable turnover indicate a collection problem from its customer. Average receivable turnover in day is increased from 28.36 in 2018 to 41.41 in 2019. It is similar to reasoning of day sale in receivable. Day sale in inventory decreased from 1.4 day in 2018 to 0.247 day in 2019. Day sale of inventory is the average number of days it takes for a firm to sell off inventory. A smaller number indicates that a company is more efficiently and frequently selling off its inventory, which means rapid turnover leading to the potential for higher profit. On the other hand, a large DSI value indicates that the company may be struggling with absolute high volume inventory and may have invested too much into the same. Inventory turnover. Inventory turnover increased from 405.5 times in 2018 to 465.89 times in 2019. This is due to a high COGS value. A low turnover implies weak sales and possibly excess inventory, while a high ratio implies either strong sale or insufficient inventory. For inventory turnover in day, dividing 365 day by the inventory turnover show how many days on average it takes to sell its inventory. In this case, it has decreased from 0.9 day in 2018 to 0.783 day in 2019, showing inventory is sold off faster in 2019. For inventory turnover per year, similar to inventory turnover. Operating cycle. The period between acquisition of goods and the final cash realization from sales increased from 2008 to 2019. A shorter cycle is preferred and indicates a more efficient and successful business. A shorter cycle indicates that a company is able to recover its inventory investment quickly and possess enough cash to meet obligation. If a company OC is long, it can create cash flow problem. Working capital. The working capital is decreased from 2018 until 2019. However, in both years, the working capital has resulted in a negative amount. It means that the company does not have enough current asset to meet its current liability. The gap has been decreased significantly in 2017 due to having lesser current liabilities. It typically indicate that the company may have incurred a large cash outlay or a substantial increase in its account payable as a result of a large purchase of product and service from its vendor. For current ratio, the current ratio is decreased from 2018 to 2019. A ratio under 1 indicates that the company debt due in a year or less are greater than its asset. On the other hand, in theory, the higher the current ratio, the more capable a company is of paying its obligation because it has a larger proportion of short-term asset value relative to the value of its short-term liabilities. For acid test ratio, decreased from 2018 until 2019. Companies with an acid test ratio of less than 1 do not have enough liquid asset to pay their current liability and should be treated with caution. If the acid test ratio is much lower than the current ratio, it means that a company's current assets are highly dependent on inventory. For cash ratio, is decreased from 2018 until 2019. If a company cash ratio is less than 1, there are more current liabilities than cash and cash equivalent. It means insufficient cash on hand as it to pay off short-term debt. This may not be bad news if the company has conditions that skew its balance sheet, such as rather than normal credit term with its suppliers, efficiently manage inventory, and very little credit extend to its customer. If a company cash ratio is greater than 1, the company has more cash and cash equivalent than current liability. In this situation, the company has the ability to cover all short-term debt and still have cash remaining. High cash ratio may indicate that a company is inefficient in the utilization of cash or not maximizing the potential benefit of low-cost loan. Instead of investing in profitable project, it's letting money stagnate in a bank account. For sales to working capital, value negative due to negative working capital. It is decreased from 2018 until 2019. A higher turnover ratio shows that management is being very efficient in using a company's short-term asset and liability for supporting sales. In contrast, a low ratio may indicate that a business is investing in too many account receivable and inventory to support its sales, which could lead to an excess amount of bad debts or obsolete inventory. For time interest earned, a high ratio means that a company is able to meet its interest obligation because earning significantly greater than annual interest obligation. However, a high ratio can also mean that a company has a undesirably low level of leverage or paid down too much debt with earning that could be used for other investment opportunities to get higher rate of return. A lower time interest earned ratio means favor earnings are available to meet interest payment. Failing to meet this obligation could force a company into bankruptcy. It is used by both leader and borrower in determining a company debt capacity. For debt ratio, a ratio greater than 1 shows that a considerable portion of debt is funded by asset. In other words, the company has more liabilities than asset. A high ratio also indicates that a company may be putting itself at a risk of default on its loan if interest rate were to rise suddenly. A ratio below 1 translates to the fact that a greater portion of a company asset is funded by equity. The higher the debt ratio, the more leveraged company is, implying greater financial risk. A debt ratio greater than 1 means 100% tells us that a company has more debt than asset. Meanwhile, a debt ratio less than 1 indicates that a company has more asset than debt. For debt to equity ratio, lower value of debt to equity ratio are favorable, indicating less risk. Higher debt to equity ratio is unfavorable because it means that the business relies more on external lender, thus it is a higher risk, especially at a higher interest rate. A debt to equity ratio of 1 means that half of assets of a business are financed by debt and half by shareholder equity. A value higher than 1 means that more assets are financed by debt that does financed by money shareholder and vice versa. Debt to tangible net worth ratio. Generally, excess of the debt to tangible net worth ratio value over 1 means that company creditors are well protected. And in case of firm insolvency, they will only recover a part of the principal and interest belonging to them. Lower than 1 ratio indicates the situation when creditor can accept receiving all the amount in full. For net profit margin, net profit margin is typically expressed as a percentage but can also be represented in decimal form. The net profit margin illustrates how much of each dollar in revenue collected by a company translates into profit. In other words, Maxis earned 0.194 cent profit for 2018 for every RM1 in revenue. This figure did not increase in 2019. For total asset turnover, is decreased from 2018 compared to 2019. This is due to higher revenue earned and large asset valuation in 2017. The higher the asset turnover ratio, the better the company is performing, since higher ratio imply that the company is generate more revenue per dollar of asset. Return on asset is an indicator of how profitable a company is relative to its total asset. ROA gives manager, investor, or analysis an idea as how efficient a company manage is at using its asset to generate earning. The higher the ROA number, the better, because the company is earning more money on less investment. For operating income margin is a decrease from 2018 compared to 2019. Operating margin is how much profit a company makes from its core business in relation to its total revenue. It is a good indicator of how well it is being managed and how risky it is. It shows the proportion of revenue that are available to cover non-operating costs, like paying interest, which is why investor and lender pay close attention to it. For operating asset turnover, the operating asset turnover ratio indicates how efficiently a company is using its operation asset to generate revenue. A higher ratio is desirable as it shows that a company is better at utilizing its operating asset to generate revenue. For return on operating asset is decreased from 2018 compared to 2019 due to a lower operating asset turnover in 2019. Sales to fixed asset. High sales to fixed asset ratio imply that the business is efficiently using its fixed asset to generate revenue, while a low ratio shows that the fixed asset of the company do not help generate revenue efficiently. Return on equity is decreased from 2018 compared to 2019. Return on equity measure how efficiently a firm can use the money from shareholder to generate profit and grow the company. Unlike other return on investment ratio, ROE is a profitability ratio from the investor point of view, not the company. In the words, this ratio calculates how much money is made based on the investor investment in the company, not the company investment in asset or something else. That being said, investors want to see a high return on equity ratio because this indicates that the company is using its investor fund effectively. Higher ratio are almost better than lower ratio, but have to be compared to other company ratio in the industry. For return on common equity is decreased from 0.72 to 0.60. The ROCE ratio can also be used to evaluate how well the company has utilized equity capital to generate value. A high ROCE suggests that the company management is making good use of equity capital by investing in NPV positive projects. This should create more value for the company shareholder. Return on total asset variation, this is decreased from 2018 to 2019, that showing a decline. The greater a company earning in proportion to its asset, the more effectively that the company is said to be using its asset. The ROTA expressed as a percentage or decimal provide insight into how much money is generated from each dollar invested into the organization. For gross profit margin, increased from 0.11 to 0.525. This is due to a higher revenue in 2019, relatively in comparison to 2018. Generally, the higher the gross profit margin is, the better. A higher gross profit margin means the company did well in managing its cost of sales. It also shows that the company has more to cover operating, financing, and other costs. The gross profit margin may be improved by increasing sales price or decreasing cost of sales.
Okay, I would like to explain about cash flow Maxis Berhad 2019. Cash flow from operating activities. Cash from operating activities allow a company to constantly generate positive cash flow from its daily business operation and is a highly valued by investors. In particular, operating cash flow can uncover a company's true profitability. It, it can be observed that Maxis Berhad maintained its cash from operating activities to certain levels. It starts with a profit for the year for RM 1,590 million, and after adjusting for non-cash items such as depreciation and taking into consideration of other items, it arrives at a value of positive RM 3,379 million for cash flow generated from operating activities. Major outflow are for tax paid RM 549 million and for changes in working capital of receivable RM 106 million. Cash flow from operating activities exceeds net income, which indicates good internal cash generation. Unlike net income, OCF excludes non-cash items like depreciation and amortizations, which can misrepresent a company's actual financial position. It is a good sign when a company has strong operating cash flow with more cash coming in than going out. Okay, then cash flow from investing activity. Although company and investor usually prefer to see positive cash flow from all of a company operations, having negative cash flow from the investing activity is not always bad. Typically, investing cash flow include the cash flow associated with buying and selling the property, marketable securities, and therefore cash changes from investing a cash out item. In the case of Maxis Berhad, RM 1,371 million is invested in the purchase of property, plant, and intangible asset. Added to that, future RM 6 million is paid out for the purpose of placement of deposit. However, there is an inflow of RM 1 million from disposal of asset. This results in a negative cash flow of RM 1,376 million from investing activity, as there is no other inflow from source in the form of dividends received or other income from previous investments. Cash flow from financing activity. A company cash from financing activity refers to the cash inflow and outflow resulting from the issue of debt, the issuance of equity, dividend payment, and the repage of existing stock. It's important to investors and creditors because it depicts how much of a company cash flow is attributable to debt financing or equity financing, as well as is a track record for paying interest, dividends, and other obligations. A firm cash flow from financing activity relates to how it's a work with the capital market investor. When looking at the Maxis Berhad cash flow from financing activity, it can be seen there is a inflow in the form of drawdown of borrowing. RM 2,000 millions, whereas they are outflow in the form of repayment of lease, finance, liability, and finance costs. Out of all the outflow, the majority of it is from paying out ordinary share dividends of RM 1,564 million. All in all, the net cash flow from financing activity arrived to a total value of negative RM 1,987 million. Okay, conclusion of our cash flow. Okay, after all the activity are taken into accounts and considered, it can be seen that Maxis Berhad net cash flow at the end of the year amount to a positive, means RM 16 million. When considered together with cash balance, at the beginning of the year of RM 536 million is arrived at the value of RM 552 million. This is the figure of the cash and cash equivalence of the at the end of the year 2019. Okay. Competitor analysis. Cash from operating activity allow a company to constantly generate positive cash flow from its daily business operations and is a highly valued by investor. In particular, operating cash flow can uncover a company through profitability. Okay, from the comparison of the two company in table, okay, it's clear that Axiata Group Berhad generated a higher cash from its operating activity. And on 2019, the higher amount was recorded from the last 5 years. On the other hand, it can be observed that Maxis Berhad maintained its cash from operating activity to a certain level. It is a good sign when a company has strong operating cash flow with more cash coming in than going out. For both organization, cash from investing activity are negative, but comparatively for Axiata Group Berhad, the negative margin is higher. Although company and investor usually prefer to see positive cash flow from all of a company operations, having negative cash flow from the investing activity is not always bad. This is because it's alright to have a negative value as a lot of long-term fixed asset and major acquisitions are involved. A company cash from financing activity refer to the cash inflow and outflow resulting from the issuance of debt, the issuance of equity, dividend payments, and the repurchase of existing stock. This is important to investor and creditor because it depicts how much of a company cash flow in attributable to debt, financing or equity financing, as well as its track record for paying interest, dividends, and other obligations. A firm cash flow from financing activity relates to how it works with the capital markets and investors. Okay, next, cash flow from financing activity represents the funds that an entity took in or paid out to finance its activity. Financing activity include obtaining financing resources from and returning the financial resources to the owner or shareholder of the organization. Investors are interested in understanding where a company's cash in coming from. If it's coming from a normal business operation, that's a sign of a good investment. It will be an interactive investment opportunity if the company is constantly issuing new stock or taking about debt. For Maxis Berhad, in the last 4 years, it has been a consistent range, whereas for Axiata Group Berhad, there has been fluctuation as seen on the graphs. But Axiata Group is trying its best to improve its liquidity situation after the loss in 2018, and therefore with the right change in operation, company performance can be established. Okay, that's all from our group. Thank you.